The absolute worst thing that I don't want to hear in this market is that I'm sitting on cash because I'm worried about a recession. Those are people that are highly fixated on aspects of the market where they're missing out on the broader view picture, because there's always places to park capital where the trend will be your friend. Now, I am not a day trader. I am not a swing trader, but I recognize these trends, and I started seeing it happen at the beginning of this year, and I started buying stocks that I recognized at all-time highs that right now are continuing to hit all-time highs. And we're going to be talking about this new trend within the market as the domino effect starts happening with large caps. So consider hitting that like button if this is a conversation that interests you folks, because you got to get your emergency fund aside. Yeah, maybe have a little bit of extra capital in case there's major dips in some of your favorite companies, but do not stop investing, because there is money to be made in this market. You just have to get a little bit beyond the Meet Kevins and the growth investors of the world. But obviously, this risk-off environment all started in 2021 with the sell-off of small caps getting hit even harder in 2022, at which we are now seeing that domino effect to lead into the FANG stocks in the large caps. I mean, take a look at Netflix here, guys. Take a look at PayPal. One of the ones that hit me the hardest is obviously Facebook. The pain of this is ridiculous. I ended up buying a bit more Facebook over the last week. We'll talk about that in my later videos, so consider subscribing for those updates. But where we're still seeing some stability that I'm a lot more concerned about is in companies like Nvidia. Some of these companies are insanely overvalued. I mean, it doesn't matter whether we're talking Microsoft or Google or Amazon or Apple or Tesla. These things have actually been boding excessively well. And I mean, Apple is the crown gem. If this sucker goes down, I'm guaranteeing the whole market's going to start selling off with it. And because these companies particularly didn't post guidance, I mean, Microsoft didn't offer guidance, Google, Apple, they didn't really offer much. But when Amazon is posting guidance of 3% for Q1, I can really expect that Q1 is going to be a rocky roller coaster. Apple has done a phenomenal job at repivoting kind of their business, basically by taking used phones, paying you a decent premium for your used phone, marking it up 30%, and then selling it in the other markets that exist out there. And that is what's really driven up the iPhone sales over the last few years. What a great business model they implemented with that. And then the M1 chip, right? But what comes after that for Q1, I don't see anything crazy going on here, right? So I'm really curious to see if the dominoes are going to start falling to these other companies. And that's when I'm going to start paying a lot of attention to things like Amazon here. Because don't get me wrong, I have a list of growth stocks that I'm looking at right now, guys, but I'm not one of these people that just wants to throw money into a pit of fire where I know there's not going to be a lot going on this year, or I don't know, they could start coming back in 3 months, 6 months, 12 months, 2 years from now. But why would you cost average into those where you know there's places in the market you're going to continue to get growth right now where you could start pivoting some capital? So if Amazon in Q1 starts posting that kind of lower growth perspective and it drops off from where it is right now, I'm going to start adding that as one of the growth positions. Many of you know I have Alibaba on my list. I have a lot of the genomic space stocks on my list, but where we need to start paying most attention to, guys, because again, I could tell you Tesla's overvalued. Obviously, Nvidia's crazy overvalued. The reason I'd be real careful with these guys is because they have this underlying fan base. They have 50% plus growth rates, especially with a company like Tesla, and that's the only thing that's keeping these things overvalued. I don't see that particularly changing, but that doesn't mean as these other companies perhaps sell off that it doesn't take those with them. So I'm a little bit more cautious toward these top weighted companies, which we're starting to see across the broader indexes, right? Because when you look at QQQ, what a great representation of a risk-off environment. Over the last year, only offering a 7.37% return if you've been in it that long. And even the VOO, guys, is now diminished down to about a 15.22% return over the last year, which by no means is terrible, right? But where the trend has been shifting to is into the risk-off environment. And man, oh man, has this trend ever really started to take off. I mean, look at the VYM here, guys. This is one that I've been cost averaging into. I actually bought more of this today. Over the last year, outperforming the S&P 500 right now, up 18%. I know a lot of you are a fan of the Schwab Dividend ETF. I mean, take a look at this guy here. We want to look at the 1 year because that's where we're going to see this comparable trend shift. I mean, it's up the exact same amount as VYM. These kind of companies are kind of following suit with a lot of the oil companies right now, the commodity companies, because they've been largely undervalued for the time being. And I've been shifting a lot of capital into banks because a lot of you, I noticed people pointed out in the comment section that banks were getting overvalued. They've been bought up a lot. But the fact of the matter is you could have said that about Tesla. You could have said that about Apple. You could say about that all those companies. But the fact is, guys, people don't want to be on risk environments. So they're going into these companies. Look at Bank of Nova Scotia, guys. It just hit another all-time high. I've been buying TD right at the beginning of the year, like I mentioned. I'm looking at adding more Royal Bank actually within the next few days here because, again, guys, the trend continues to be your friend. Do not underlook these aspects of the market just because they're going up right now, because that nobody's going to sit on cash. I'm telling you that right now. If you are pulling hundreds of billions of dollars out of Facebook, Nvidia, all these large cap companies in a hyperinflated market, that's the dumbest thing you could possibly do. Instead, we're going to start seeing all of that cash start allocating to different sectors, and that's the money you want to follow. You don't want to be following guys that are highly fixated on certain aspects of the market because, again, I'm a long-term investor. I'm not day trading. I'm not swing trading. I am just readjusting my portfolio and parking capital where I think I'm going to get the best near-term return, because then I can reallocate the dividends that I get from this back toward growth when I start seeing that secular shift begin to happen again. And for as long as we're going to start seeing these rocky quarters for the next, 6-8 months, why keep throwing money into a fire? I get that we all have long-term time horizons, guys, but I'm just trying to point in the path of least resistance because this is how I've generally been able to outperform the market, because it's not rocket science to recognize where large money goes. And for as long as that money continues to go that way, guys, how do you lose? It's fairly hard if you're diversifying into a multitude of these companies. So I've been buying the banks. I've been buying VYM. I added one new dividend stock that has been trading down, not Clorox or anything like that, but we'll talk about that in my next video, more related to the healthcare sector. And this is what I'm going to continue probably doing for the beginning half of this year, nonetheless, because I've topped up my RRSP. I've been adding a little bit more capital here and there, and I've actually been scaling down some of my growth positions because obviously I recognize that, Facebook isn't going to particularly be doing as well in this environment. But don't get me wrong, I did end up buying more Facebook back because I underweighted it out of one account to top up my RSP, at which I re-added a fairly decent amount of the position back, because over the long term, I still love where these companies are going. But the whole point, guys, is you have to kind of play these short-term trends, or you're going to continue to see your accounts go down. And that's not something that I want to see out of your accounts. Now, again, this is all macroeconomic stuff. This could be considered speculating, but this is stuff I stated at the beginning of the year, and it is proving to continue to work out. So we'll see if that continues to move forward, and that's what we're going to see happen for the next little while. But at this point, folks, I'm going to pass the question off to you. In this domino effect of this market, what do you guys think's going on here? Where are you most allocating toward? What kind of gets you up during the day and say, hey, I see something going on there where there's going to be more value adds? I would love to hear about that in the comment section below. But in light of this, stay cool, stay awesome, and I'll catch you in the next one.